Good morning. Today is the May 11th, 2021 meeting of the Lextran Employees Pension Committee. I'm Jill Barnett, Lextran's General Manager. Due to the COVID-19 pandemic, state of emergency, and Governor Beshear's executive orders regarding social distancing, this meeting is being held via live video teleconference pursuant to Senate 150, as signed by the Governor on March 30th, 2020, and Attorney General Opinion 20-05, and in accordance with KRS 61.826, because it is not feasible to offer a primary physical location for today's meeting. I'm now going to turn the meeting over to Nikki Falkenberry, Lextran's Director of Finance and HR.
Good morning, everyone. I'm hearing an echo. I think we have a quorum. We have Daryl, Ed, and Brian in the conference room, and I see Rick and Fred and I, so that makes a full meeting. Thank you for joining us today. We have two presentations. We have Pamela Thompson from Mariner for our regular quarterly report, and we also have Steve Osborne for our annual actuarial report. So if we can look at the minutes for the February 9th meeting, if you've had a chance to read those, if we can get a motion to approve those. Any motions to approve the minutes?
This is Rick. I'll make a motion to approve.
Okay, do we have a second?
So moved.
Was that
Brian.
Brian or Dale? Brian, okay. Thank you. Okay, the minutes are approved. We will now turn it over to Pamela from Mariner.
Great, thank you, Nikki. I will share my screen, which has a presentation that hopefully all of the committee members received already. Can you all see that?
Yes.
Okay, great. Yeah, so we are here for our quarterly review. Would have loved to be in person, but I do think you can probably see and hear us a little better this way versus with masks and everything on. I always like to start with just an update of our firm. Not a lot of new news other than that we have continued to grow. We're adding to our team. Happy to be, local now. As I think you all know, we do have 2 offices in the Louisville area serving all of our Kentucky market. So this is just some of the recent statistics, in terms of our number of professionals, et cetera. Just a quick view of who the local team is. This is the advisors that serve our Kentucky markets as well. So you see myself and Matthew here will be presenting today, but it really is a fantastic team that we have here serving Kentucky. We always then like to do a brief overview of your investment policy statement. This is a very important document that you own, but it is one that we work on with you to make sure we are all on the same page and can meet your investment objectives appropriately. So this page here is the summary of that plan. The key to this, I'd say the most important part of it, is the asset allocation. You can see we have targets and ranges. The target range for the stock allocation is a 50 to 80% range. That is what will drive the growth of your plan long term, because stocks are the element in our investment universe that do grow. But as we all know, they come with some volatility over short periods of time. And so it's very important to have a cushion from the bonds and the cash. And we also need to have cash from a liquidity standpoint as payments go out to retirees. So the balance that you are targeting here is one that will provide moderate growth over time. And it will also be buffered a bit when we see volatile periods in the market because there is a balance. Everything else about the investment policy is really just to make sure that it is very well diversified, very high quality. You'll see limits on position sizes or particular sector weightings, that kind of thing. And so it's just to make sure that's very prudently managed and that we are all on the same page as far as meeting your objectives for this overall plan. Are there any questions about the policy itself? And the full document was in what was sent to you also, so I'm not going to hover on all of that. Okay, so we will move then into the investment review. I like to start with just an overview of the market environment that we've been in. This slide here is looking at last year, and you've already seen this, but I think it's helpful just to put things in context. So as you know, last year was a very volatile time due to the COVID pandemic, the shutdown that occurred last spring. And so you can see in this chart, there are a number of different stock index returns being shown. They all moved pretty much in tandem as we went through this last March is when we saw the really big drop. But surprisingly for a lot of folks, we did see a very quick rebound, moved into positive territory later in the year and finished with actually very nice positive results across the board, whether you're looking at US or international stocks, or whether you're looking at large companies or small companies. It was a quick rebound, and I think I like to remind clients that it's a very important reminder that the stock market is a forward-looking mechanism. A lot of times people scratch their heads and say, you know, how could the market be up so strongly earlier last year when we still were not, you know, nearly out of the woods from a pandemic standpoint? And the reason is that the market had already, what we'd say, priced in what was currently happening and had kind of put the realization in there that we will get through this. It's just a matter of time. And so the market is always looking out into the future and was pricing in the fact that we had a lot of assistance from the government, a lot of stimulus that was being put back into the economy. And that has helped tremendously as we continue to get through this. The next page just looks at so far this year. This is through the end of April, looking again at, you know, US versus international, large company, small company. You know, the patterns aren't quite as similar to each other, but it's generally all still positive. So we have to see a continued increase in the market. And this is really as we are in an environment where the economy is continuing to recover and actually showing very nice growth so far this year. And we'll get later into some of the detailed data that we look at, but we've seen a lot of positive indicators, and that really is fueling this continued growth in stocks, together with the fact that interest rates are very low. And that tends to be a positive environment for growth, but it also makes it such that stocks become a more attractive alternative to bonds when the interest rates on bonds are very low. So then turning to the summary of the portfolio, this is the overall snapshot. The pie chart is showing you the allocation at the end of the first quarter. You can see we were at 74% in terms of total equity, so at towards the upper end of your range of 50 to 80%. And that is a range that allows us to kind of work with the environment that we're in. And so this is one we do want to be tilted more towards the equity side. In the pie chart, you can see how that is distributed. The largest portion of the equities is in US large companies. That is being done with a balance of both active and passive management. I know we've talked about that before. Matthew will get into some of that detail. We are doing individual stocks, but we are also using some passive ETFs that we've used for years, just in different proportions. And then you can see the small cap and the international as well. So all that together makes up the 74% equity. And then right now there's 26% on the cash and fixed income. And that is, again, that's there for a buffer against volatility and provides a steady stream of liquidity as it's needed to be making the payments to the retirees. The returns then are in the upper right-hand corner. Hopefully you can see the numbers there. We've already reviewed 2020, which was, again, a very strong year. The total balanced portfolio return is at the top. So the full year last year, we had a 13.5% return, and that's for this, you know, moderately balanced portfolio, which is, I think, well above what anyone would have expected when we were going through this pandemic. The first 4 months of this year, we're up another 8.5% for the balanced portfolio. So it's been a very, very strong period. You can see below that, you know, the total portfolio is at the top, but then the two subcomponents are below, the fixed income and the equity portion. And then it's on the heels of a very strong 2019. So we've still got that year listed with a total portfolio of 21%. And then our long-term return has actually been an average of 7.4% per year, which I believe is well above the actuarial assumption that's being used. And so we'll hear more about that when we go through that report. I'll pause for any questions. And I do apologize. My internet, I think, is a little bit jumpy. So that's why my audio is on my phone. Hopefully it won't cause a problem on the slides here.
Pam, what did you say the long-term return was again?
The long-term annualized return is 7.4% per year.
Okay.
That's an annual equivalent. With the two components, the fixed income return has been 4.1% for the long term, and the equity has been 9.4.
When you say long-term, how many years is that?
That is since 2003. So we are looking at a total of 17 years. And that's really what is the most important. You know, as we all know, we're going to get different kinds of returns over different periods, but that long-term return is what is really making the difference over time. So then I will hand it off to Matthew to go into some of the detail on both the equity and the fixed income.
Mm-hmm. Yeah, so what we're looking at here on this slide are all of the stocks in the actively managed individual stock portfolio. And what we've done here is separated them into 3 different categories based on their type. So I'll start on that far left-hand column, and this is going to be what we would consider to be the stable core of your stock portfolio, comprised of more income-oriented stocks that will be either paying a higher dividend yield or they'll be consistently growing their dividend. The stocks on this left-hand column are also going to have a lower beta or tend to be less volatile when compared to the market as a whole. The center column is going to be the more opportunistic, cyclical growth stocks that are going to tend to fluctuate with the business cycle. And then that farther right-hand column there is going to be the higher growth stocks that are going to be consistently higher growth and faster growing companies, either because of the industry that they're in or their business model. And the stocks here on this farther right-hand side they're not going to be as sensitive to the business cycle. But the main focus on this page here is just that nice balance that you can see we have between all 3 of the different categories. And as you know, we will make strategic adjustments to the weighting in any one category just based on what we're seeing in the market. This next slide here is our risk control slide. So we and our investment team are always monitoring the size of each individual equity position just to make sure that you don't have a concentration that becomes too large in any one company. So if you take a look down that far right-hand column on the screen here, you'll see that your largest is Kansas City Southern at 4.1%. That's also within your investment policy statement range. If any of those were to creep above 5% or so, we'd look to trim them back from there. It's also nice on this slide to just compare that total cost versus the total market value column. So you can see the top 10 alone, they've all grown to the size that they're at. It's also nice to look at the sector column, and you can see that the top 10 are very well diversified across a number of different market sectors. And I just wanted to highlight a few stocks that are listed here. So that first, Kansas City Southern, I'm not sure if you're familiar with that company, but it's a railway, and they're a very strong performer over the last 12 months as well as year to date. So where the S&P 500 is up about 11.5%. Year to date, Kansas City Southern is up about 51%. Another nice company here, or an interesting one, is ON Semiconductor. They're the 3rd company down listed there. And what they make is a number of different semiconductors and microchips that go into a lot of different types of electronical equipment and things like that. And they're another company that's outperformed the market so far this year, up 19%. FedEx, which I'm sure you're all familiar with, is another great company here in the top 10, also outperformed the market at 13% so far this year. As Pam mentioned, we are blending that individual or the actively managed individual stock portfolio with the passive funds, whereas the individual stock portfolio represents 60% of the total equities. This passive side of the portfolio represents 40% of the overall equities, and it's very important to note that we do have that blend. You can see on this page we're listing all of the different funds that you own in the portfolio, and you can see that they're well diversified across asset classes in large cap equities, small cap, as well as small and mid cap, as well as international funds. And on the large cap side, it's important to note that there's been a significant shift from growth outperforming to value outperforming over the last year. And then this last page here of the detail for the portfolio is a review of the bonds. As you all know, the bonds are a very important piece of the portfolio. And what they're going to do is act as a buffer against volatility as we see it in the market. Because of that, we don't take any unnecessary risk. And per your investment policy statement, we're invested in all very high quality individual bonds. That quality rating pie chart on the right-hand side of the screen is telling us that all of the bonds that you own are of investment grade, so very high quality. On the left-hand side of the screen, you can see the maturity distribution pie chart, and you'll see that staggered or laddered nature of the maturity distribution. And that's very nice, because as those bonds do kind of gradually come to maturity, we will be evaluating where interest rates are at and then redeploying that capital accordingly from there.
So that's the summary of the portfolio detail and overall allocation. And then we always do like to just provide a little bit of commentary on kind of what we're seeing in the economy and the market and kind of our outlook for that. So we have really, first and foremost, one of the most important elements within the economy is the job situation. So here we're looking at the weekly report that is on the initial claims for unemployment insurance. This is going back to the beginning of last year. You can see the significant spike that we saw as we went into shutdown with the pandemic. You can also see that that has been declining. It has continued to improve, even just through last week. Still above where it was before the pandemic. So we do have, further to go, but definitely moving in the right direction. And that really is the key as we're evaluating kind of the future and the future growth of the economy. A similar view here of the continuing claims. So while the initial claims is what, a new filing for unemployment each week, these are the ones that are ongoing of individuals that are still seeking employment. And again, you see how it increased very rapidly last March and April, that has continued to also decline. Again, has further to go, but we do see it moving in the right direction, which is what we're focused on. This is a chart looking at just retail sales. Again, this is a big part of the economy. We see a very sharp drop from the pandemic. That actually came back very quickly, came back fully, and has continued to grow. This is assisted tremendously by the stimulus packages that have come through. We've seen, income going directly to some of the most affected people. We've had the PPP program for small businesses, for nonprofit organizations, able to keep more people employed because of that, and that has allowed people to continue doing the things that they do and spending money in the economy that helps continue to drive growth. Similar situation in the housing market. So the housing market is one that really has a domino effect. There's so many elements that play into it. That here we're looking at overall home sales on the left, and then housing starts for new construction on the right. Again, sharp drop that we saw last year, but that has come back fully and is one of the stronger areas within the market right now, or within the overall economy right now. That is assisted by the very low interest rates that we do have. This is actually a long-term chart going back to the beginning of the 1990s, and you can see, the overall trend down. But then here at the very right-hand side of the chart, you see what happened with the pandemic. We actually had a 10-year Treasury bond yield drop below 1% for the first time ever. Got to just ridiculously low levels. We have now seen that come back up to where it was before the pandemic, but still at a very, very low level. Right now, we're kind of hovering between 1.5 and 1.6% on a 10-year bond. Very low interest rates, do continue here, and certainly have been one element assisting, the housing market being as strong as it is. It's, helps mortgage rates to be lower. We would say, as we look at the outlook, however, with the increase in growth that we're seeing across the economy, and with the additional stimulus that is planned and proposed by the current administration to really help continue to fuel growth in the economy. We would not be surprised to see expectations for inflation start to pick up. And so that could quite likely become kind of the next area of concern. It's too soon to be concerned right now that that's going to be a kind of a sudden shift, but something that we really want to keep an eye on. So as you know, as a lot of the stimulus, something that will lead to higher inflation. If it does, that does mean interest rates would tend to go up. From where they are now, a little bit of increase in interest rates would be a welcome thing. You know, we're still just a little bit too low in our opinion for just a comfortable balance. But as you see interest rates start to pick up, you can get concerns then in the stock market because higher interest rates will tend to, you know, cause maybe a reset within stocks, particularly with the valuations. So we're not quite there yet, but something that we're definitely keeping an eye on. The final chart here is one that we've done before, but I think it's an important reminder of how often we do get corrections in the market. So this is a chart going back to 1980, and every year is shown here with a gray bar, which is representing what was the total move in stocks for the year. Just looking at the S&P 500, was it up or down for the year and by how much? You can see out of all of these, you know, 30 out of 40 of them are positive, and that's what we expect. We do expect the market to go up more than it goes down. But there's also a little red dot underneath for each year with a number that represents the largest intra-year decline that occurred. So at some point during the year, the market fell, and what was the largest amount that it fell during that year before things progressed and finished wherever that gray bar is. I don't know if you can see all these numbers, but there are quite a few that are down by 10, 15, 20%, or even more on many, many different years. But a lot of those years, the market does still finish positive or continues to move ahead from there. And so I would just say it's something that we oftentimes forget about. You know, when it's quick, we see a correction, things move on and do better. It's easy to kind of forget that happened. But I think seeing it this way is just a really important reminder that it is common. On average, we do get a correction about once a year. And of this particular period of time, it was an average drop within each year of about 13.8%. So what I would say at this juncture is that we are now at a point that it has been a year since we had a correction. The one the last one was a really big one. We had a 34% drop last year. So we would not be surprised to see a correction at any point. Again, that's a normal thing. That does not cause us to want to go run and hide and wait for it to happen, you know, sell the stocks and wait for it to happen, because there is no guarantee of when it will happen. So it's something that's a really important reason to always be focused on the balance in the portfolio, making sure that it's balanced appropriately for the risk tolerance, for the growth objectives, and for the liquidity needs. But then at that point, what we're doing is watching, and as things are high, we're going to be trimming them back as we do get into a correction mode again, which we will at some point. You know, we actually look forward to that, and those are great opportunities, particularly on the active side of the portfolio, where we can find individual stocks that have dropped, and it's like going to Target and everything's on sale. You know, so we find great companies that we're able to purchase at lower prices, and so we actually do, you know, look forward to that and find that just a nice tool as we manage the portfolio. So I will stop there. That's the end of our presentation, but I would be very happy to answer any questions.
Pam?
Yeah.
I don't see Facebook on here in our portfolio. That was our best stock for years.
Yeah, I have to look. We did decide to go ahead and sell that one, but we've got a great lineup of different tech stocks that are in the portfolio.
Thank you, Pam. Are there any more questions? Okay, we'll move on to the actuarial report. Steve, we'll turn it over to you.
Thank you. And I think, does someone have that on, they can put on the screen, or does everyone have a copy of it?
We can put it on the screen for you.
All righty, if you don't mind.
Alan, can you take care of that for us, please? Thank you.
Thank you. And I am just going to go through about 4 or 5 pages, so I will let you know when to move that on. What I've done here, what's up on the screen is the January 1st, 2021 actuarial evaluation of the pension fund. And the most recent results are in the far right-hand column there, along with comparable figures for each of the last 2 years. You can see in terms of the number of people included that continues to go up, and that is predominantly because of the number of retirees, people drawing a monthly check continues to grow up. It's not that you're adding 10 additional employees every year. I mean, there are, I think, 2 more active employees in the plan this year than there were a year ago. But the big increase is in the number of retirees. There are, at the beginning of the year, there were 64 people drawing a monthly check. The market value of the assets was 17.2 million, reflecting a net investment return that we calculated of a little under 14%. So that was pretty good. Thank you, Pam. That always helps out the actuary. And then finally, we have their contributions in terms of cents per hour and the recommended rate of 206. And you're actually between Lextran and employees putting in $2.27 an hour. You mentioned your 7.4% return over the last 18 years. The assumption is 6.5% a year going forward. So that's what we're using at this point. If you can go one more page, thank you. The actual contribution rate again is 227 and a recommended rate of 206. So you are putting in at least the recommended rate. And again, I said that assumed a 6.5% return. If we assumed the future returns would average 6%, then the recommended rate would be 227.9, or about $2.28, about a penny more than what you're actually putting in, which is going to be close enough. The big change since last year was the investment return. The liability has gone down, or the unfunded liability has gone down. In fact, there is no unfunded liability. Last year, you may recall that in 2019, you had about a 20% investment return, and that moved, and that completely eliminated your unfunded liability a year ago. So a year ago, you were actually 105% funded, and this year you are 114% funded. Those numbers are not in the report, but I thought I would give them to you. And I think that is, I think that's remarkable. I think that's great. And you probably know, I mean, even where I am, I still see articles on the public sector retirement plans in the Commonwealth of Kentucky, and they are not the highest ranked, as you know. So having this plan to be 114% funded probably puts you at the top of the heap, if not, or at least close. So good work. I was not asked to do this, but while the computer's going, I do look at what it costs to change things. And those are on the next couple of pages. If you could skip to page 4. There you go. Thank you. Again, no one asked me to do this, but these are things you've looked at in the past, and I'm not suggesting that you make a change. It's easier for me to do this now than like you asked me 3 months later to come back and do it. While computer's going, it sort of spits all these things out. Your benefit rate is $50 now. If you wanted a $60 rate, you would need to increase your contribution by about $1.05. Now that's a proportional thing. So if you said, well, let's get what is a $5 increase cost, and that's half of what a $10 increase costs, or about 52 cents. So those are proportional. I don't think you've given raises to retirees in the past. That's item number 4. Item number 9 is called a pop-up by most people. So when you have a person retire, they get their pension for their lifetime. In lieu of that, they can take a reduction in their monthly amount and leave 50% or some other percentage to their spouse. So if my pension was going to be $1,000, then I wanted to leave some to my spouse, my benefit may come out to be $900 a month. And then when I passed away, my spouse would draw $450. Some plans have it so if your beneficiary dies first, that is, I took a $100 cut in my pay, but now my spouse has died first, and they allow the $900 to pop back up to the original 1,000 if the beneficiary dies first, and that cost a couple of pennies. All right, if you would turn one more page, I do want to point out areas of risk, which is the category at the top. So every retirement plan is subject to risks. So you have 336 people in the plan, so you could say we got 336 areas of risk. But I do want to point out the main 2 areas of risk are your hours, because that is the basis of the contribution. And of course, we're not contributing on overtime hours now. We're assuming 320,000 hours a year, straight time hours, and a 6.5% return. If the assets actually had a 0 return, the recommended contribution rate would increase gradually, not all at once, but by about 35 cents. And if hours fell to 300,000 annually, the recommended rate would increase by about 15 cents. I was going to look up what hours have actually been. So they've actually been running in the 360 to 380,000 a year level.
Are you saying that's with overtime?
Well, the overtime changed in 2018. So before that, with overtime, they were running about 380. The
Yeah.
2 complete years without overtime have been running around 360. I was actually kind of expecting that to drop to around 340 to 350, and then I was going to assume 320 just to be a little bit on the safe side. So straight time hours are actually running ahead of what we thought they would be with the change in the contribution rate. Other areas of risk are something that would, cause more disablements than usual, or if life expectancy jumped all of a sudden. Now we're using the newest life expectancy table for public sector employees in our projections. So those are your areas of risk. The rest of the report is in the format it's been in the past. There's really not anything in the bulk of it that I felt important enough to cover at this point, but I'd be glad to answer any questions you might have about this report or the funding of the plan.
Steve, what are the dollars that are going out of the fund to beneficiaries in dollar terms?
Sure. If you'll turn, if you can go back, keep going back to page 3, there's a page 3 at the bottom. A couple more. Oh, no, I'm sorry, go the other direction. Right there, all right. So there at the bottom shows the benefits, both I'm keeping track of the monthly amounts separate from the lump sums. So the monthly amounts, which is shown as pensions, have gone from 594 a year to 502 to almost 513,000. And right now, or in January, sorry, let me Looking for that. Well, they're going out right now at a rate of 539,000 a month for 2021. Not a month, a year, 539,000 a year. Let's try to look at monthly amounts. So that's almost 45,000 a month, Rick,
Mm-hmm. What are refunds?
where people leave and take out their own money, get a
Oh,
refund of their own contributions.
at some point down in the, I mean, in the long term, do you always want, or would it always be that the contributions plus the interest income will exceed the amount going out in a particular year? I mean, that's your goal, right? For the long
Yes.
term. Yeah.
And you're fortunate that just the contributions are exceeding the outgoes right now.
Yeah.
So your plan is in good shape. This is not one that I lose sleep over. So
Steve, when a person takes their part out in the refund, they are not entitled to any future benefit?
actually, if they are vested when they leave, meaning they have, I believe it's 5 years of service, and they take out their own part, they can still get a pension. And there's several people that are in that category. So if your pension was going to be $600 a month and you took out your own part, and then what happens is we figure out what part, how much your own part would have purchased, and then that's reduced. So you take out your own part, your benefit instead of being $600 might be $350 or $250 or whatever. Now, if you're not vested when you take your money out, then there's nothing else payable.
Thank you, Steve. Anyone else have any questions?
Is our pension fund insured? And if
It
so,
is
by who?
not insured. There is no, in the private sector, there is an agency called the Pension Benefit Guaranty Corporation that sort of insures private sector plans. It depends on the kind of plan it is. Some of them aren't insured at all, and some of them are only insured up to a pension of about $1,000 a month.
So this plan
But
is not insured.
yours would not be insured, and I'm not sure how state law would apply if your plan actually ran out of money. I mean, that varies from state to state. Some states have held that if when they run out of money, that's it. Others have held that the state has, in essence, guaranteed these benefits some sort of way. And then there's also the issue in your plan of whether you're a state plan or whether you're just a county governmental plan, which could have different guarantees. I don't think I would count on anything as a backstop to your plan. That's why it's very, very important to keep it well funded. Plus, if you look at Kentucky in particular, your plan's not going to be the one that runs out of money first. So, if all of them ran out of money, you'd probably be the last to the party and there may not be anything left.
Thank you, Steve. We're always happy to hear that it's well funded. So thank you very much.
Thank you.
We are going to move on to old business. Since we are in a open procurement, I would ask that Pam and Matthew drop off the call for us, and we will continue since we're going to talk about the RFP.
All right, great to see everyone. I'll talk to
Thank
you
you.
soon.
Thank you both for
Likewise,
joining us
thank you.
today.
Okay.
Okay. I just wanted to go over quickly with you. Last year when we did the request for proposal, we had a tie with the committee. So we have re-released that this year. We have added Steve Osborne to our committee, so we will have 7 members of the selection committee. The RFP was advertised and issued on April the 29th. We had a pre-proposal conference on May the 7th. We had a few companies join us that just for very few questions, but they do submit their questions in writing. So the final questions will be due today, and then we will answer those questions and get the addendum out to them by May the 14th. The RFP, the proposals will be due on May the 21st by 3 p.m. And if we happen to do interviews, if we decide that we need interviews, they'll be around June 1st, but we will work with all of your schedules the best we can to make sure that everybody can be on those interviews. You should receive emails from Bonfire. Stephanie Hoke, that's on here with us, she has set up for everyone to receive those emails so that you can evaluate the proposals just like we did last time in the Bonfire system. And those, like I said, will be due from the proposers by May 21st. So between May 21st and May 28th, we will need for you to review those. Daryl, Ed, and Brian, if you need computers set up in a conference room, we can always do that. Just let Alan know ahead of time if you need to a laptop to review those. The contract will be awarded at the June board meeting because the current extension with Mariner ends on June the 30th. So our new contract will begin July the 1st of 2021. So does anybody have any questions about that?
Nikki, what do you think about having a page limit on those proposals? Some of them are long.
Some of them are very long, you're correct. We've already put out the scope.
You have, okay.
But we were very specific this time on the investment policy. Last time we had some a little confusion on what our investment policy was. And so this time we've been very specific, and we will, on the addendum, we can include that we would like something to be in, I wouldn't say the short as possible, but I did request that the pre-proposal to be in layman's terms because this isn't, this pension isn't our core job, so we need something that we can understand easily. So. Anyone have any questions? Do we have a motion to adjourn?
I've got one other question. It's not about the RFP.
Okay.
Several have asked if they could see the amount that they have in the pension fund on Paycom. Is there
It's
some
in,
way
it is in Paycom. I sent out the directions last month. I could send those out again. It's under, if you go into your Paycom, you can go to information, and it is under there, and it says the amount of pension that you've put in as of December 31st, 2020.
Okay, thank you.
Nikki, this is, I'd like to make a motion that we look at increasing the benefits from our pension fund to new retirees of maybe $10 a month. And the motion that I want to make is let's poll the pension contributors to see if they would endure the cost of raising the benefit of at least $10 a month.
Steve, I'll let you address that if you don't mind.
Okay, so the cost of that would be about 11 cents.
Yes, sir. I read that in your report.
Okay.
So I want to make that motion. If anybody wants to second it, I certainly would appreciate it. Brian?
In order to increase the amount of what's going in the pension plan, That's a union negotiation item. So that would have to be negotiated in the contract, and then we could raise, after we get an additional 11 cents, then we could raise the benefit. But we would have to have that negotiated into the contract.
Are we not currently negotiating?
We are currently negotiating. That would have to be an item. Jill, would you like to address that?
Ed, I would encourage you to speak to your negotiations team about presenting that as a proposal at our next scheduled meeting for negotiations.
Okay, I'm asking you, Jill, would you see that as being a problem to introduce that into these negotiations?
We will entertain all items on the table.
Thank you.
Steve, to put that in perspective, how much were we over this year? Was it 24 cents or in terms of?
Yeah, it was 227 compared to 206.
Oh, 20 cents. Is
Yeah.
that correct?
Yes, sir.
And that would take up, and that was a good year,
Right,
and that would have taken up about half of it. Is that correct?
right, right. In fact, it was 2 back-to-back good years.
Yeah.
Okay, are there any other questions? Do we have a motion to adjourn?
I'll make that motion to adjourn.
Thank you, Rick. Do we have a second?
Mr. Combs or
Daryl,
operators.
I saw Daryl raise his hand. Daryl, are you seconding us? Okay. Before we do that, I forgot to mention, the next meeting has not been set yet because we will send the meeting schedule to the board of directors and it will be voted on. Currently, the tentative date that we will probably look at will be August the 10th if we follow our same schedule that we're doing now. So if you'll pencil us in for August the 10th and at 10 a.m. and then we will get back with you when we get the date set. Okay. Thank you all very much and have a great day.
Bye.
Bye-bye.